Hello everyone and welcome. This is Marco Palmero, and in this video I want to talk with you about the difference between inductive reasoning and deductive reasoning when it comes to small business acquisitions. Now, you might be wondering, why do we even need to reason in a certain way when we're looking to acquire a business or just find, analyze, and negotiate deals? Well, because small business acquisition imply the analysis of a lot of information, a lot of data, and also necessitate you to make a lot of decisions. In order for us or you to be more effective and more productive in this process, it is important to approach every single step with the right mind frame. And most importantly, make sure you're using the right data to arrive at your conclusions. And so I've seen over time that people approach small business acquisitions in a wrong manner, and I'm going to give you examples that are going to explain the reasons for that later. But before we actually dive into the topic itself, let's just take a step back and clarify what do I mean by inductive reasoning and deductive reasoning. I will just break the two down with a couple of examples. So when we talk about inductive reasoning, we fundamentally are saying that we start with very specific observations, like patterns, for example, and we then use these patterns and these observations to drive general conclusions. So an example I could give you for that is if we were to sit at a coffee shop for, let's say, 30 days in a row and observe people coming in and out of the coffee shop, we might notice a person that is coming in exactly at the same time every single day, let's say 11 a.m. And that person orders every single day a cappuccino. Let's just use it as an example. Now, if we observe that event happening for 30 days in a row, we might drive the conclusion and arrive at the conclusion that that person comes to that place every single day at 11 a.m. and orders a cappuccino. Now, you might say, well, that might not necessarily be true because it might just be a coincidence, right? And in fact, inductive reasoning has some flaws because you are never 100% sure, but the more observations you make, the more tests you go through or more patterns you see, the higher the probability that your conclusion is going to be right. And so if we were, for example, to stretch the time frame for evaluation and say, okay, we're going to spend 180 days at that coffee shop, and we would see that pattern repeat itself every day for 180 days, we could fairly assume that that person is performing that action every single day, no matter what day of the year we're talking about. And so the more data we collect, the more patterns we see, the more information we got, the higher the probability that our conclusion is going to be right. And the interesting point about inductive reasoning is that it's driving conclusions that are falling outside of the premises themselves, which means that conclusions are not necessarily confined within the information that we collected when we started our observation. And so I feel it is a very interesting mind frame and kind of frame of thought, and it is quite useful when it comes to small business acquisitions. And I will get to the reasons in a second. Now, before we do that, let me give you an example of deductive reasoning. With deductive reasoning, we're almost doing the exact opposite. So we're starting from general premises, and we're using these general premises to drive very specific conclusions. Now, an example of that might be chickens or birds. Let's just say that. So we might say birds lay eggs, and so we might drive the conclusions that chickens lay eggs, okay? Now, you might say that sounds quite straightforward and quite easy. To some respect, it sounds easier than inductive reasoning. But the problem with deductive reasoning is that it is relying on the fact that the initial premises, so the general premises, need to be right. So if we start with the wrong premises, all our reasoning that comes after and all our conclusions as a consequence are going to be wrong. And let me give you an example to explain this. Let's just use the example of the chicken again. And let's say we start with the general premise that all animals that lay eggs are birds, okay? Of course, it is incorrect, but if we assume that is true and we start with that premise and we consider that as a real truth, then what follows might be snakes lay eggs, and therefore snakes are birds. As you can see, there's a mismatch in there. And the reason why there's a mismatch is because we started with a wrong premise. And the problem with deductive reasoning is that we can never come to a conclusion that has information that is not contained in the premise itself. And the problem with that is creates a vicious cycle where if we don't input the right information from the very beginning, we are never going to be able to get the right solution or come out with a right answer. Now, as you can imagine, in acquisitions, there are pros and cons of both models, for sure. But when I look at some examples that I can give you, I see inductive reasoning being much more effective because it enables you to observe patterns and collect data that will then enable you to arrive at a decision based on information that you collected in patterns that you have identified in a certain acquisition. For example, you might want to check how many customers are coming in every single day in a certain business to see if the revenue that they're reporting is actually accurate. You might want to see how employees are upselling every customer to see whether or not the staff is performing or is not trained well enough and stuff like that. So it is very trackable. And when you look at inductive reasoning and you stack data, on top of each piece of information that you collect, you can then arrive at a conclusion that is quite accurate in most cases. When it comes to deductive instead, there might be some problems, especially if you start with assumptions and premises that are just theoretical and they're not really based on reality and what the market is all about. Let me give you an example. Most professionals might say, well, if a business provides you with financial audits, so audit statements, most likely the financial information is going to be accurate. So the initial premise might be financial statements are reporting an accurate and precise financial position for a certain company. Now, if we were to use that initial premise as our framework for deductive reasoning, we might say, okay, then this business has audited financials. Therefore, that business has accurate financial positions. So the performance that they reported is actually on point. Well, let me tell you that based on my experience, that is far from the truth, because I've seen many companies that were reporting certain figures in their audit statements, but in reality, the performance was completely different. And there was a huge mismatch between what was reported and what was actually real. And so I've seen a lot of similar scenarios happening in small business deals simply because some of the technical rules that are applied to mergers and acquisitions and business buying in general do not apply to small businesses because it is simply a different animal. We cannot reason in the same way that big corporations do because it's a different ball game. And sometimes people make the mistake of comparing the two and using similar frameworks to make their analysis. And that's why sometimes they end up with bad deals or they end up making the wrong decisions. So getting back to my point about deductive reasoning, there might be an assumption that we're making or a premise that we're making about a certain market that is considered to be quite hot. So we might say every single business that we acquire within that industry is going to be a slam dunk. But we might not consider the fact that the premise itself is wrong and the market is in a bubble. And so we are betting on something that we're not 100% sure about. But since we're using the wrong premise, we can never know that because we're trusting something that has no fundamental basis. Now, you might be wondering then, how do we get some fundamentals? How do we get some base of truth that we can rely on for making our conclusion, making our decisions when it comes to the acquisitions of a small business? Well, from my perspective, it all comes down to inductive reasoning, because we start with very specific observations and we start to collect patterns. We do our best to collect patterns so that we can then arrive at a conclusion based on the information we collected. And I gave you a few examples before. Once we have a certain elements of proof, so to speak, that stack up on each other, then we can fairly say that that company is doing X. For example, if we checked the revenue, not only in the audit statements, but with the customer inflow, with the bank statements, with the post transactions, with the invoices and stuff like that, there are a lot of elements that are piling on each other, and every single element of proof of our observation is confirming our conclusion that those financials might actually be accurate. But of course, we cannot just rely on general premises like deductive reasoning does, because otherwise we would never know what is the real truth, because we might be in an environment that is completely different. And so the rules and the boundaries that are set in business acquisitions might differ depending on the industry you're in, the country you're in, and many other factors. And so I feel, based on my perspective and my experience, that inductive reasoning enables us to be more precise in our evaluation, and also enables us a higher degree of freedom in understanding more about the deal without being influenced by, again, general assumptions or premises that might not actually be true or might not actually apply to that specific business. So, in short, I feel inductive reasoning is the way. Of course, there are certain situations where deductive reasoning can also be quite helpful, but they're dependent on the situation and the deal itself. Let me know what you think about this. It's a little bit of a technical outlook about transactions and acquisitions, but I feel is important because the mental approach toward a transaction makes all the difference in success or failure. If we start with the wrong information and we don't know how to read the situation, chances are we're going to build a castle on the sand and we're not going to be able to close a deal successfully or a successful deal. So check out this video multiple times if something that I mentioned is not clear enough. If you wish to work with my team for finding, selecting, and even closing transactions in any market, in any industry, you can check the links below. We have different levels of support that we provide to people. You might be looking at qualified opportunities, motivated sellers. We help with that. You might be looking at a done-for-you support and one-on-one support or consulting support, and we do that too. Check out the links in the description. They're going to be immediately at the bottom of the video, and then I will see you in the next one.